Good afternoon, everyone. Good afternoon. And welcome to Call Conversations. I'm Marvin Fausto, President of COL Investment Management, Inc., and I will be your host for today's webinar. In today's market environment marked by heightened volatility and uncertainty, many investors are seeking more stable and consistent sources of returns. That's why this session is anchored in a timely and relevant theme on how to earn income amid market volatility. So far, we have highlighted the top 3 income-paying funds in our webinars and the funds that we like. And our top pick remains the Manulife Global Multi-Asset Diversified Income Feeder Fund, or GMADI for short. We like this fund because this fund has paid out over 6% net dividend for the past year and even given consistently. In fact, the latest one is 6.6. No? Last year was 6.3. Now, the latest monthly dividend was about a per annum of about 6.6% net. And it has given this consistently on a monthly basis. So what we did is to look deeper into this fund by inviting the fund manager himself to tell us more about the fund and see how this can be a good addition to people's portfolio in this kind of a market. Paul Kalogirou of Manulife Investment Management. He is the managing director and head of client portfolio management based in Hong Kong. Paul is responsible for providing client portfolio management support to Manulife Investment Management's regional multi-channel sales distribution team. So he's the ideal person to talk about this fund. Paul has 21 years of financial industry experience, including 17 years based in Asia, handling different functions on research and strategy among global multi-asset classes. So, without further ado, ladies and gentlemen, let us all welcome Paul Kalogirou of Manulife Investments. Hello, Paul.
Hello, Marvin, and hello, everybody online, and thank you very much for having me. It's great to be here, great to be speaking with your clients.
Great. Thank you very much for indulging our invitation. We are really very interested to understand this fund, our top pick income paying fund, the Manulife Global Multi-Asset Income Fund. So let's get into this right away. Just a basic environment to put everybody in perspective. Can I ask you a few questions about the markets in general? Since, markets, both bonds and equities have been very volatile in the recent past. With this heightened uncertainty caused by the US trade tension, the tariff, stock markets, and even interest rates, the 10-year bonds are up and down, very volatile, and it's now back to where it started during the year, as if nothing happened. Was that just a blip? Or are we now over the issues that affected these markets? Are the concerns on tariff now behind us, Paul? Can you give us more clarity on that?
Yeah, so it's certainly been a very interesting month, and I think a lot of us as investors have had a pretty difficult time, maybe periods of panic or periods of uncertainty and periods of anxiety of what's happened with the Trump tariffs. It's worth noting that, and we've got a slide on the screen here that, this is what the headlines are looking like today from the Trump tariffs. And if we go on to the next slide, these are what the headlines look like sort of in Trump's first term. They're very, very similar, and there are very, very similar concerns back then under Trump 1.0, and we've got the similar concerns now, albeit, where do we go from here? Tariff anxiety, I think we've passed the worst, which is positive for markets. I think we still have quite a bit of uncertainty around growth, so we do have downside risks to growth, and we're in the middle of that, and we have to manage and navigate through that. We do have some upside risks, I think, to inflation still to tackle, albeit more recently inflation has been coming down. Again, that's a positive point for markets and a positive point for the Fed. And then we're sort of shifting from tariffs towards taxes. And we've seen more recently these tax bills going through the US government. And these may be stimulatory. So the markets are obviously waiting to see what these tax bills are going to come about and whether that'll be positive for markets. And lastly, I should point out, we've had some monster Middle Eastern deals done by the Trump administration, which again could pose upside macro risk for the US economy. So there's quite a lot to contend with. And I think hopefully we can give our audience a bit more understanding around markets and try and sort of put together how we see the outlook going forward and what type of solutions we can recommend or think about when it comes to the next sort of 6 to 12 months.
Great, Paul. Just following up on what you said. So we really want to understand now, where do you believe the global stock markets are headed now? Where do you see this headed with all of these things happening?
Yeah, so I mean, I think the next slide we have, I can maybe just flash up on the screen. I mean, this just shows the amount of uncertainty that we've had in these markets. And just going forward, again, when we go on to the next slide, we get an idea of the full retracement that we've had up to now. So we've had a very good, strong bounce off the lows. So what next? So if we just look at some of the data points, so the labor market in the US, the jobs data is still resilient and still very strong. We're yet to see cracks in that labor market. And so this is a positive for markets. So that's a good thing and a good thing for the Fed. I think we're all waiting for the Fed to cut, but we must be mindful of what we're asking for here. The Fed isn't cutting. That's because the US market is still strong and still resilient. And there's no need for the Fed to cut currently. Inflation is moderating, but the Fed is still concerned that inflation may start to pick up. And so we're in this sort of holding pattern by the Federal Reserve, and we're waiting for them to gather more data and then to sort of embark upon their cutting cycle. If they start to cut rates because inflation is moderating, that's a positive thing for markets. If they start to cut rates because growth is really, really slowing down, then that's a pretty negative thing for markets. So we have to be mindful of why the Fed is cutting. And so our view is that we're going to see maybe 2 to 3 rate cuts this year. We see the economy in the US in a pretty good spot. Again, labor markets, job creation in the US is positive. Inflation is currently trending down, but we are sort of mindful of where inflation is going over the next few months. And so our view is that investors should try and diversify a lot more than they were doing over the last 2 years. I guess investors were very heavily weighted towards the US. We still like the US market, but we have to be mindful that we should diversify a lot more into other markets that are around the world. So a lot of non-US dollar assets also we find are appealing. And so we'd advise upon clients diversifying into US plus maybe Europe, Asia, China markets as well. So we do have a sort of a neutral view on equities currently, and that's based upon we've had a very strong uplift in markets, and we feel there's a bit of consolidation to come from these markets. We could see a technical recession, given we might have 2 negative quarters of growth, but I think the smart investor will look through those negative 2 quarters of growth. We're not expecting a prolonged deep recession here. US market is still holding up, still resilience around the job data. We've got some tax cuts coming from the Trump administration as well. And so, yeah, we're reasonably in a reasonably good spot, I think, for risk assets at the moment.
Wow. So you said a lot of things there, Paul, a lot of things to digest. But maybe just try to focus our attention on, you said that there were 2 rate cuts. You're expecting 2 rate cuts and maybe some weakness on the economy. But I think the US, particularly the 10-year bond of the US, have been going up at about 4.5%, which is basically the benchmark of all bonds in the world, like in the Philippines. Where do you see these rates moving, given everything that you said? Where do you think this interest rates on the 10-year bond moving, given everything that you said?
Yeah, so I mean, we're expecting a couple of rate cuts to come through, but that's a function of a strong US economy. I think when it comes to the bond market is very cautious about the current status of the debt situation in the US. So we've obviously had downgrades by certain credit agencies over the last number of years, the recent one more recently. And the bond market is a little bit concerned, and that's why yields have started to push higher. Our views is that we may see an incremental uplift in these yields. Potentially that we've seen the 30-year surpass that 4.5 or that 4.5-5% level, or 5% level on the 30-year. So yeah, there is some cautious creeping into the bond market. The equity market is yet to maybe be as cautious as the bond market. One positive point around all of this is going back to fixed income. There's really some attractive yields in these fixed income markets, and even if you do start to look at fixed income, yields are expected to remain higher for longer, and you can get some really attractive yields, particularly within the GMADI portfolio, where yes, there is some high yield exposure in there, but you're clipping 7+% high yield coupons there, which are very, very attractive. We see rates remaining higher for longer, despite only say 2 cuts that are going to come in. We're still going to have elevated rates, and we feel investors should really get paid for that. Really take advantage of these higher yields and really capture those higher yields and get income into your portfolio while you can, while these rates are high. So there's a few things to think about, and so income investing, I think, is an area we like, and I think we can do that, a lot of that, through fixed income.
Yeah, great. So at least we're getting a little bit of yield on the fixed income, but you have a very volatile market, the stock market side, and with all of these things happening in the multi-asset space. Let's talk deeper into why we are here. We're actually talking about this fund that we like, the Manulife Global Multi-Asset Income Fund. How could that be an ideal investment in this kind of a market? Can you talk to us on that?
Yeah, so our view is that fixed income is offering a compelling alternative to some high valuation equities. And so again, income investing, we feel, is an appropriate, more defensive way of playing these current markets. There's a fair amount of uncertainty that we foresee in these markets, whether it be the Fed, whether it be growth profile globally, whether it be inflation, whether it be the dollar. And so we feel income investing, which tends to be more defensive in terms of the portfolio construction, is critical in terms of helping navigate some of these risks that could come about over the next 6 to 12 months. This chart here really shows how diversification sort of works. There isn't always one winner in these markets, and so we take a very diversified approach. The GMADI portfolio has around 900 names. It taps into many markets, many geographies, and really what we're trying to do is tap into as many income sources as possible and capture as many parts of the income spectrum as we can, and get that into the portfolio and make sure that's delivered out to our clients. And so if your clients currently have or taking risk with either some high flying tech names or high flying tech related investments, which a lot of people like, and I understand why they like the high growth, high earnings growth, but they're also high valuations, then we're advising clients to look at something complementary to that, which is an income defensive portfolio that can bolster your overall portfolio should we start to get cracks in markets. So this is why we like the GMADI portfolio. It's a high income generating portfolio. I think we talked about it at the beginning. The local fund is delivering over 6% in terms of payout on a net basis, and that type of return, or income, I should say, is very consistent since the birth of GMADI in 2019, and so we foresee that income profile to continue into the foreseeable future as rates remain elevated.
Yeah, Paul. Yeah, thank you for the rates still elevated. We're getting this income, and you're saying that over 900. So really, 900 names are really diversifying the fund. No, I just want to understand now. While interest rates now are high, markets still believe that rates are going to come down. You yourself said that there's going to be 2 rate cuts. Probably rates can still remain elevated this year. But maybe next year, or maybe in the coming years, rates are going to go down. And we might not see these kind of yields that we're getting, particularly for the Manulife, the GMADI, this fund, is there a strategy that you come up with to make sure that these payouts are sustainable? Like, how sustainable can that be for the coming years? Like, for example, a retiree wants to just generate income on a monthly basis or a cash flow basis. Is there some kind of a strategy that you do so that this income generation will be sustainable?
Yeah, so we do have a chart with that. I'm not sure if it's the next one or the one after, but if we go on to maybe the next chart
Yeah.
here, okay.
Okay. That one.
So what we've done here is the green line is the GMADI payout over time. So what the GMADI, the target fund this is, what it's paid out over its history since it was born in 2019. So as you can see, that green line is reasonably consistent. It's high single digit payout over time. So then what we've done is map onto that is where the Fed fund rate was in that period. So if you go back to 2019, the gray chart there just shows you that Fed rates were zero back then. If you remember, rates were zero, but we made this portfolio resilient and ensure that we pay out this payout even with rates at zero. So for us, when we see rates potentially coming down by two to maybe 50 basis points this year, and say if it does come down another 100 basis points next year, we've already been through, the GMADI portfolio has already been through a period of zero rates and has still been able to deliver 7.5% on the target fund payout. So for us, we are pretty confident if rates go back to zero, we can deliver the 7.5% again. We're not expecting rates to go to zero. But hopefully this chart just really evidences that over time, this portfolio has had a consistent, sustainable payout for our clients. Just to sort of help clients understand that a little bit better, I'm part of the distribution committee on this particular fund as well. So I get a very good idea about what people are thinking about in terms of maybe increasing the payout or actually decreasing the payout. These things take an element of time to sort of progress through. They're not just going to make one decision at one meeting. And so I can tell you all at this meeting there is no case for the rate for the payout to be cut on this portfolio in the foreseeable future. So we're pretty happy and confident that we can generate some really good income, good attractive coupons from the bonds in the portfolio, some good dividends from the equities, and we also have an option writing piece here that really does enhance the income payout of the overall portfolio. So if it's paying out this 6.5, 6.6, I think there or thereabouts over the next year or so. It may come down slightly if rates come off 50 basis points, but I don't see the income payout dropping considerably on this portfolio, no.
That's great, Paul. That's great to hear. No? So it's kind of a little bit uh, comforting that you said that even if rates go down, I mean, this is the Fed funds rate go to zero, you are still able to do that. Is that because you're able to lock in long-term yields that are giving you high yields now? Even if rates go down, you have that income generating asset or this fixed income that gives you those 6 or 7%. Is that the strategy that you have done so far?
Yeah, so there's a few things. The portfolio has a number of levers. If you think of the fund that has to be flexible throughout a rate cycle, and on the simplest terms, the levers that the fund can pull to be flexible are in the fixed income space. So it can reduce and dial down risk, or it can dial up risk if it wants to through IG or through high yield. It can go into developed markets or emerging markets, or it can also look at preferred securities, and there's attractive yields across that spectrum of fixed income securities. And we can really tap into that and really capture high attractive yields for on that. On the equity side, we're not necessarily buying equities in this portfolio to achieve huge dividends, because dividends on global equities tend to be sort of 2% or so. But what we do here is we have an option overlay writing strategy, which what happens is you convert that equity into more of a cash flow generating security. So what you can do, I try and simplify it and say you forego potential future upside for income today. So yes, in a way, you write the options and you can enhance your yield by receiving a premium every time you write these options. And so that's what we're doing with GMADI. And it's these three components: fixed income, equities, and option writing, they really are the big drivers of income generation, particularly fixed income, as you'd expect. It's traditional fixed income generating security, and the option writing is very critical to generating income for the portfolio. So yes, it is a flexible portfolio. We can evidence here that it's worked when rates were at zero and we still had a mid-single digit payout. And yes, there's lots of levers the fund can pull to help navigate and mitigate different rate cycles, inflation cycles, growth cycles, and have a steady NAV over time. And that's one of the core aims of the portfolio.
Great. So you mentioned, Paul, just to give an idea, retail investors are watching us, and in the Philippines, we are very familiar with fixed income, giving you interest income. We're quite familiar with that. The dividend income generated from stocks, also we're quite familiar. You mentioned options writing. This is not very understood by our retail investors because it's not really very prevalent here in the country. We don't have that much options writing, as you said. That I think the way I understood what you were saying is that these are also equities, but it is not really functioning as an equity as we regular investors understand it. But you generate some kind of income. Can you just elaborate that a bit so that you have three components of income now? You have the fixed income, you have the dividend income on stocks, and then you have income on these options.
Correct.
Can you just kind of a little bit explain that a little bit further for us? Thank you.
Yeah, so often people think of options, they suddenly may think it's risky, but actually the broad use of derivatives is often used to mitigate risk or reduce risk. And so with the option writing, the fund is not actually owning options. It doesn't buy options, it sells options. So once you sell an option, you receive a premium. The buyer on the other side will give the fund a premium. And that premium we hold throughout the month. And if equity markets go above a certain level, we need to give that premium back to the buyer. And if equity markets fall a certain level, we need to give that premium back to the buyer. However, because we're writing calls and puts that we're writing, we're getting a premium from both. What tends to happen is as markets go up, the calls are struck out and we lose the call premium, but we collect all the put premium. Likewise, when markets fall, we lose the put premium. We need to give it back to the buyer, but we collect all the call premium. So we're always going to be collecting some form of premium through option writing if we're writing calls and we're writing puts. There may be occasions when the market actually finishes in the middle of both of these levels, and we collect both the call and the put premium. So really, sort of to sort of simplify it, I try and said it before, we forego future upside to get income into the portfolio today. So option writing gives us a layer of generating income, and we can do that persistently. We can do that on a monthly basis. We can do that sustainably. And we have a team focused on really generating that income into the portfolio, and option writing is one area we can do it on.
Yeah. It's just a huge market in the global markets. It's a very huge market. It's very liquid, and everybody's doing that.
Yeah. I mean, so these are, so even from a less riskier standpoint, we're writing these options on indices. So these are not on single securities or single names. We're not writing an option on, say, Nvidia. We're not writing an option on Meta, so it's not on single stocks. It's on broad S&P. So yes, given GMADI's holdings are global, for example, we have US holdings in this portfolio, we would write on a very broad liquid S&P index. And so yes, these are very liquid, very available pricing. These are exchange traded options. They're done on indices, so there's less risk doing it on indices than doing it on single stocks where there is more risk. And so, yes, these are very, very, very liquid markets. We write them on the S&P, we write them on the Nikkei, we write them on the FTSE, and we write them on emerging market equities as well. So they're the broader markets, which I think most of your investors are very familiar with, and so that's the sort of the foundations around how we implement the option writing strategy for this portfolio. Yeah.
Yeah, great. That's what I like about these global markets that we Filipinos cannot access in the country, but buying the fund effectively allows us to benefit from that kind of a market that we don't really benefit here. So
Right.
I'm telling you, Paul, we're familiar fixed income, we're familiar with stocks and dividends, but the options premium is basically like an interest income, right?
Yeah, you're very right. I mean, predominantly option writing has always been implemented in institutional type portfolios and never has been put into a retail type portfolio. And so we wanted to bring this solution and bring this component to our retail audience. Yes, you're right. There was an element of concern amongst investors around what these are, because often derivatives are seen as riskier. But actually, in this case, we're using options to mitigate risk. And I can give you one example, actually. I think I should give an example rather than just talking about it. For example, if your vanilla equities, your normal equities fell, you have option premium that you've generated that you can offset against the negative returns of equities. Whereas if you didn't have option writing, you'd just be stuck with a drawdown of the equities.
Yeah.
Whereas you have the option writing, the income that's coming in, say you generate whatever 2-3% per annum on the premium from the option writing, you can offset that against your drawdown of your equities. And so it really reduces the volatility, it buffers downside risk. And so this is one key feature of bringing that option implementation into the portfolio for our clients.
Yeah. Okay, I like that. I like that. Thank you. So just a last question on this one, so that we have a lot of advanced questions from the audience that we asked, and there are hundreds of them. So, and we will also have a live Q&A. In the interest of time, Paul, just a last question on you. How did you divide the strategy from fixed income, equity, and these options so that your income now will be sustainable?
Yeah, so the next slide, we sort of have a breakdown of the portfolio. You can see it's fixed income dominant, I'd say, only just it's about 55% fixed income securities. So again, we wanted to create a portfolio that delivers a high income, but does so at a lower volatility rate. There's a number of multi-asset income portfolios out there that often rely on the growth of equities. They have a lot of equities in their portfolio, and we sort of said, look, if you have too much equities in your portfolio, you rely on equities outperforming to make the payout. And we wanted to be a more of a pure income focus. We wanted to generate income from coupons, from dividends, and from option writing, and make sure that's paid out to our clients, and not sort of sit back and think we have to rely on equities outperforming or grow equity markets to continue to perform to make the payout. And so we made a fixed income dominant portfolio, as you can see here. Which, as you can expect, if we want to pay 6 to 7% payout, we have to be in that high yield bucket. So there is credit risk here in this portfolio. There is credit risk involved in this portfolio. And then the next part of the portfolios are equities, and there's around 20% in global equities. And these are your global national developed market names, very familiar names that you'll be familiar with when you see the breakdown of those portfolios. So does have access to sort of your usual high flying tech names. It's got your global healthcare names in there, some consumer discretionary names in there, and then the last part is your put and call writing, which again helps to generate income for the fund.
So this way, just to clarify, the equity related securities, these are the options that you're saying. So the
Included,
the blue bar are equities and
yes,
options that you're saying.
Correct. And then the breakdown of that is, say, 50-50. So 20% is in pure vanilla equities, and then the rest of that 22% is in put and call writing. Yes.
And the equity part, the pure plain vanilla equity gives you an opportunity for any capital appreciation.
Yeah.
In case,
So the equity part is a real driver of returns in the portfolio. I think over the last 5 years we've had a US bias, and that's somewhat changing as these markets adapt and change, and we have to adjust to that. But equities have been a driver of performance, whereas fixed income and options have been a driver of income. So yeah.